Imagine waking up one morning and your currency has lost half its value. Banks are shutting down. Companies are going bankrupt. Your savings, gone in real time. That was Asia in 1997. And today, the question many investors whisper but few dare to say publicly is this: could Vietnam face a similar crisis? Could history repeat itself? Right here. Let's break it down clearly, simply, and with zero fear. Just facts, cycles, and patterns. Financial Atlas style. To understand whether Vietnam is at risk, we first need to understand what really triggered the Asian financial crisis. Here's the crisis in 3 simple points. First, overheating economies. Thailand, Indonesia, South Korea, Malaysia. They all experienced huge growth, massive foreign investment, and a booming real estate market. Everything looked unstoppable until it wasn't. Second, the currency trap. These countries pegged their currency to the US dollar. This means they fixed its value. So when the US dollar strengthened, their exports became more expensive and less competitive. Their debts, often in dollars, ballooned, and foreign investors started to panic. Third, the capital flight. Panicked investors rushed to pull their money out. Funds fled the region. Currencies collapsed one after another. Banks failed. People lost their jobs, their homes, their businesses. It was fast, brutal, and contagious, spreading like a virus across the continent. It was a perfect storm of rapid growth, a rigid currency system, and sudden panic. So, why do people fear Vietnam could be next? Today, Vietnam is one of the most dynamic and fastest-growing economies in Asia. But rapid growth often brings vulnerabilities. Let's analyze the concerns one by one. Concern number 1. Rapid credit growth. Vietnam has seen high credit expansion, especially into real estate. Whenever debt grows faster than the overall economy, economists start sweating. That's exactly what happened in many Asian countries before 1997. Concern number 2. Real estate overheating. Are property prices rising faster than what average people can afford? Are developers borrowing heavily to build more and more projects? Is there too much speculation in the market? This sounds eerily familiar to the situation in pre-crisis Thailand. Concern number 3. Corporate debt. Many Vietnamese companies rely on short-term borrowing to finance their operations and expansion. This is dangerous, because when liquidity, the available cash in the system, dries up, businesses that depend on rolling over their loans can fall very quickly. And concern number 4. Dependence on foreign investment. Foreign direct investment, or FDI, is Vietnam's superpower. It has fueled its manufacturing boom and economic rise. But it's also a risk. If global investors get nervous and pull their money out suddenly, just like they did in 1997, the shock could be painful. So yes, if you squint, there are some similarities to 1997. But here's the important part, the part that changes the entire story. Vietnam is actually much stronger and far more resilient than people think. This is the part of the story almost nobody talks about, and it's the part that changes everything. Here's why Vietnam is different. First, and most importantly, Vietnam does not have a dollar peg. This alone removes the single biggest vulnerability that caused the 1997 crisis. Instead of a fixed exchange rate, Vietnam allows its currency, the dong, to move gradually and be managed. There's no pressure building up that could lead to a sudden, catastrophic collapse. Second, Vietnam has strong foreign reserves. Today, Vietnam holds far stronger foreign currency reserves than Thailand had back in 1997. This acts as a massive financial cushion. It's enough to manage shocks, enough to buy time in a crisis, and enough to help stabilize the currency if it comes under pressure. Third, controlled capital flows. In 1997, money could exit Asian economies almost instantly, with the click of a button. Vietnam's system is more regulated. Moving large amounts of capital in and out of the country is slower and more controlled. In a moment of global panic, this friction is an advantage, not a weakness. It prevents a stampede for the exit. Fourth, A healthy export machine. Vietnam is one of the world's strongest and most diversified export-driven economies. It's not just one thing. It's electronics for major global brands, it's garments and textiles, it's furniture, it's agriculture like coffee and seafood. This diversified export engine provides stability, even during global shocks. And finally, government intervention capability. Vietnam's government and central bank have shown they can, and will, act quickly and decisively. They've moved to control credit when it grew too fast. They've taken steps to cool the real estate market. They've supported the banking system and actively stabilized the Vietnamese Dong Viet. This level of proactive, coordinated response simply didn't exist in the more freewheeling economies of 1997. So, is Vietnam 100% safe? Of course not. No country is history doesn't repeat, but it often rhymes. So let's break down the realistic risks that Vietnam must watch very carefully. Risk number 1. Too much real estate leverage. This probably won't trigger a 1997-style crisis, but a slow-burning bubble is possible. Some over-leveraged developers or corporate bond issuers could fail. Households that borrowed too much could feel the pain. This would be a painful correction, not a total collapse. Risk number 2. A global recession shock. Vietnam is deeply connected to the world economy. If the US, Europe, or China enter a serious recession, Vietnam's exports will slow down. Foreign investment will slow down, and economic growth will slow down. This wouldn't be catastrophic, but it would certainly be painful. Risk number 3. Domestic debt restructuring. The corporate bond market in Vietnam needs to be cleaned up. Some companies that borrowed irresponsibly will have to fail. This is a necessary, if difficult, part of a maturing economy. And risk number 4. High interest rates worldwide. When the US Federal Reserve raises rates, it increases financing pressure on emerging markets everywhere. It makes borrowing in dollars more expensive. Vietnam has navigated this challenge fairly well so far, but it remains a constant headwind. So, could Vietnam repeat 1997? Let's give you the truth simple and honest. Vietnam could absolutely face corrections. It could face economic slowdowns. It will definitely go through a period of debt restructuring and see continued pressure on its real estate market. But a Fusca? 1997-style Asian financial crisis repeat? It is highly unlikely. Why? Because Vietnam's financial system, its policy structure, and its currency framework are all fundamentally different and more robust. In 1997, many Asian economies were fragile, built on a shaky foundation. Today, Vietnam is far more resilient, far more diversified, and far better managed. The best way to predict a country's future is to understand its past and to read the patterns clearly. Vietnam has risks, like every fast-growing economy on the planet, but it also has deep, structural strengths that most people underestimate. If you want more deep, simple, cinematic breakdowns of financial history and global economics, you already know what to do. Subscribe to Financial Atlas.